Hello everyone, today is Wednesday, February 5. Let's take a closer look at the charts for the euro and the British pound and assess potential market movements. As you can see, the European currency extended gains against the US dollar, completely filling Monday's gap, caused by President Donald Trump's comments on tariff targeting imports from Canada, Mexico and China. He decided to hold off imposing 25% tariffs on Canada and Mexico for a month, prompting the market to lean into long positions. Meanwhile, disappointing U.S. economic data, including weaker-than-expected labor market figures and factory orders, further weakened the dollar, allowing the euro to extend its recovery. However, many analysts view this as a temporary pause, pointing out that the U.S. economy remains robust. They warn that Trump's new trade restrictions will likely weigh on risky assets, with the dollar expected to regain its strength in the longer term. This scenario seems increasingly likely. After all, President Trump has yet to address tariffs on imports from Europe, so the most significant developments are still to come. In addition, dovish remarks from Fed official Mary Daly yesterday suggested that the U.S. economy is in a good position and that the central bank does not need to react hastily to the policies introduced by the Trump administration. These comments added pressure on the dollar as markets began to expect a more dovish stance from the Federal Reserve, potentially continuing its trend of interest rate cuts. Now let's turn our attention to today's macroeconomic calendar. It features the final readings on services activity from major Eurozone economies, including Spain, Italy and France. The bloc services PMI is forecasted to dip slightly to 51.4 in January, down from 51.6 in December. Meanwhile, the composite PMI is expected to rise to 50.2, surpassing the 50-point mark, following a December reading of 49.6. If the data comes in stronger than expected, it could fuel further bullish momentum for the euro. The UK is set to release similar data, with services activity showing signs of resilience. The services sector continues to support the economy, and the January reading is expected to come in at 51.2, slightly above December's figure. This could provide a boost to pound sterling, potentially strengthening its momentum in the market. Furthermore, traders may take notice of the Eurozone's Producer Price Index data for December, with expectations for a 0.5% increase following November's 1.6% rise. Next, attention will likely turn to U.S. economic data, with the ADP National Employment Report expected to show a rise of 148,000 in private payrolls. A stronger-than-expected result could boost the U.S. dollar and shift market sentiment in its favor. What is more, the U.S. is set to release data on services activity, which is anticipated to show solid growth. With several key reports due today, we can expect increased market volatility. Moreover, remarks from ECB chief economist Philip Lane and Fed officials Austin Goolsbee and Michelle Bowman will add further intrigue to the session. With a packed calendar, it is day to watch for potential market-moving developments. From a technical standpoint, the 1-hour EUR-USD chart suggests that the strong economic data from the euro area could push the pair up to 1.0398. A false breakout at this level will trigger a sell signal, potentially sending the euro down to 1.0360. If the price breaks through and fixes below this mark, a further decline to 0.322 and possibly 0.278 could follow. At these levels, it would be wise to go long on a rebound, aiming for an intraday correction of 25-30 pips. Long positions at 1.0360 can be considered in the event of a false breakout. Alternatively, if the price breaks through and consolidates above 0.398, amid mixed data from the US, the volume of long positions is likely to increase, with the euro climbing to 1.0432 and possibly 0.464. At this mark, I recommend going short on the rebound, expecting a 25-30p move. Going short at 1.0432 and 0398 will only be relevant on the false breakout. Speaking of the British pound, the market remains under the control of bulls. A decline followed by a false breakout at 24.49 or 24.16 would generate a strong buy signal. Going long on a rebound at 23.80 could be a prudent move, anticipating an intraday correction of 35-40 pips. If the price breaks through 24.86 and consolidates above this level, supported by positive data on the services activity, the pound sterling could rise above January's high of 1.2519 and head for 25.71. At this mark, I recommend going short on a rebound, counting on the 35-40p move. Short positions at 1.2519 and 24.86 should only be considered if a false breakout occurs, particularly in the event of weak UK data. Good luck to all.